On this episode, we bring on a special guest to talk everything real estate. Welcome to Think Heart. Okay, welcome to episode number 12, Think Heart. I'm Scott Goodfellow. This is Ben Hart. As usual, we're the Hart Investment Group. You can find us pretty much on every social media platform there is. Just search up Hart Investment Group and you'll find us in there somewhere. Same thing on the World Wide Web, as they call it. Just Google Hart Investment Group, and you'll find us there, too. The thing I always forget to say, too, is you got to like and subscribe these videos if you're watching on video. It helps us get found more, so that'd be very helpful if everybody could do that. And if you're listening on audio, if you give us a 5-star review. Okay, now that that's over with... I have mixed emotions about this episode. Ben, as you know, I came from real estate. I spent 20 years in the industry. And from an industry standpoint, this episode is kind of like, when the ex-girlfriend meets the new girlfriend. You know what I mean?
It's true.
And it's kind of that awkward moment.
Am I the new girlfriend?
Yeah, you're the new girlfriend, right? Exactly. From industry standpoint, let's be clear about that. I'm just not sure what side to take. They meet and you're like, hi, So it kind of feels like that. So it might take me a while to ease into it, but here we go. Without further ado, I'd like to introduce our guest, Reni McNeil from Mortgage Brokers, Ottawa.
Hi,
I thought
thanks for having me.
Yeah, great to have you. Ben, why don't you kick us off with some questions? Well, actually, why don't we start with Reni? Why don't you first tell us, so that we don't forget, where people could contact you if they're looking for mortgage help in the Ottawa area?
Just like you said, pretty much every social media platform that is out there. So it's pretty simple. It's Reni McNeil Mortgages on Instagram, Facebook, LinkedIn. Reni spelled a little different because my mom wanted it to be special, so it's RENI. But yeah, pretty easy to find me on there.
Awesome. Yeah, I've been calling you Reni since I found out that we're doing this. So we'll try to get it right.
All right.
I'm sure you get that a lot. Yeah, exactly.
A lot, yeah.
Okay, so why don't you start off by telling us a little bit about yourself and your background?
Okay. I've been in the finance industry for about 15 years now, previous to being a mortgage agent, which will be 3 years in May, actually. My previous life was with a large financial institution where I did a little bit of everything, financial advisor on a lower scale, not quite the same as Ben here for sure, but jumped into management after that, and probably that was something that helped me gear towards wanting to be self-employed at the end. Went out and joined Mortgage Brokers Ottawa, like I said, just about 3 years ago, and been loving every second since.
Awesome. So you're kind of like on the other side, right? Like from the industry X standpoint, like we're the X from the industry.
We are kind of the X, yeah.
Right?
Yeah.
This is like
interesting
a weird
though.
thing.
So the role that Reni left before she became mortgage agent, the manager that was in there now also just left and did the same thing. I'm wondering, that's like the hot seat.
Yeah. Just to get right out of there. Yeah.
And maybe we're in the wrong industry, Ben. Maybe we should become mortgage brokers.
Who knows? Maybe by the end of this.
That's what I was going to say. Maybe by the end of it, Okay, Ben, why don't you kick us off with the questions there, and I'll jump in with
Sure. Yeah.
insights.
Yeah. So look, Reni and I have known each other, I'm going to guess probably 10 years or so now. And so we've worked certainly in our previous lives. We worked together on working together with joint clients, and we also, often did joint events together, and certainly have a high amount of respect for Reni. And she's also done personal business for us as well on the mortgage side. So excited to have a good conversation with you tonight and see where it goes. Obviously, I get lots of conversations with clients about real estate, and one of those challenges is not to get into an argument with them, just trying to find out what it is they're looking for. And so this should be great. Housing market's been on fire, and certainly look forward to having a discussion with you tonight. So I'd like you to start maybe and really kind of just tell me a little bit about what mortgage agent does, what kind of role there you have, and what it is that you do right now.
Sure. Yeah, I mean, it's, a mortgage agent benefits, and I get asked this question quite a bit because a lot of my previous clients from my other institution still reach out to me. So,
Sure.
it's kind of hard because when you're somewhere for 11 years and doing mortgages for these clients, they always think that that specific location is the best, and they don't necessarily see the benefit of what I'm doing now.
Sure.
The big thing is kind of a one-stop shop. So with one application, one credit check, I can shop around for my clients at over 60 different lenders that I have access to.
Wow.
Another big benefit as well is, there's the A lenders, the big banks with people with perfect income and perfect credit and, some established history for themselves. But not everyone always fits that bill. A lot of self-employed people, try to
Hmm.
claim as little as possible on their taxes. So it makes it harder to get, especially into the Ottawa market today.
Sure.
We have different categories of lenders that we're able to use. So it's not just kind of a one product, one box type of solution that I have. So it's great because
Yeah.
it can pretty much get anybody a mortgage. It just might look a little different than the standard people are used to.
Yeah, for sure. I didn't even know there's 60 lenders out there.
Oh,
No,
way more.
Yeah, oh, way more.
I
Okay.
thought there
Yeah.
was six,
Okay.
right? All the big banks, and that's it.
Yeah, exactly. So who are all the lenders? Like besides the banks, like who else is the one that comes to the market?
Name them
Obviously, some
alphabetically.
of them must be for self-employed.
How, how long do we have? Um, there's a lot of what people would call monoline lenders, trust
Okay.
companies, credit
Okay.
unions. So,
Okay.
there's the alternatives out there. And we have MCAP, which is a big kind of monoline lender. So, meaning they only do mortgages.
Okay.
And a lot of those times I kind of gravitate towards some of these lenders because they can pass along some lower interest rates to my clients. Their prepayment penalty calculations are much more favorable than the big banks. And they have all the same perks that kind of the big bank lenders do. So I could list a million of them, and I'm probably going to get in trouble with
Sure.
some of my favorite lenders for not mentioning them. But there's definitely lots that I have access to.
Yeah. Yeah. So since you've worked in the business a long time, how different is this market today than it was, 10 years ago? What's happening? What's going on right now?
Um, I, I can see a difference even from 3 years ago when I started.
Okay.
3 years ago, we weren't waiving conditions on almost every single offer a client was putting in on a home. These days, if we tell a client they can't waive a condition on their purchase agreement or their offer of purchase, they're out
Yeah.
of they're out of it. Like there's no way that
Wow.
they're winning. So it's a really, really tough market. It's changes by the minute. We see rate changes multiple times a day.
Yeah.
Over the past year, especially with everything
Sure.
going on,
Yep.
some regulation changes have happened. Lenders gotten a little bit more strict with documentation and income confirmation and things like that. So,
Yep.
10 years ago, I would say, "Oh, you're working? Perfect. Give me a pay
Yeah.
stub. Here's your mortgage. Have a great day." I
Yeah.
basically need blood tests these days. It's crazy.
Yeah. Yeah. Yeah.
Yeah.
I'm familiar with that as well.
Yeah. Yeah.
Yeah. Maybe I could just jump in to add
Uh,
to that, Ben. I was just
sure.
wondering how it works now because you're in situations where there's multiple offers. As far as the appraisal, right? Because that's part of what you do. You have to get an appraisal. So you see some places in Ottawa going for 100 up to $400,000 over asking price. How does that affect? Like, you have to get an appraisal before a mortgage, right? Typically, and will they sometimes
Sometimes.
deny it if they don't think the value's there, or how does that work?
Yeah, we've seen that. So typically, if it's a high ratio mortgage, so less than a purchase with less than 20% down, the default insurer, so Seguin, CMHC, or Canada Guarantee, will do an appraisal on their own on the back end. So that's kind of a little bit simpler for my clients. If it's 20% down or more, so a conventional mortgage, some lenders will want to have an appraisal to make sure the value is accurate. So at those situations where we know we might want to waive the financing, we're preemptively going in and maybe doing an appraisal ahead of the the offer if the sellers
Okay.
will allow it, so that we know the value's there. Because if we waive all financing and a lender comes back, or the insurer for that matter comes back after they've waived and said, we want to make sure this value is as you're purchasing it for, and it comes in less, the client is responsible excuse me, to pay the difference in their own cash or savings, whatever it is.
Right.
Have you seen that happen?
Yep.
Yeah,
3
yeah, yeah.
times in the last 2 weeks, probably.
Oh, wow.
Really?
Okay.
Yeah,
So it is
it's getting a
happening,
little
yeah.
crazy. I find appraisers are getting a little bit more cautious. When
Sure.
this all started, they were just 9 out of 10. The appraisals will come in at what the purchase price was. They're just kind of, okay, someone bought it for that, it's worth it.
Sure.
But lately we've seen them come in 40, 50, thousand under what the purchase price is. So lenders will always take the lower of the purchase price or the appraised
Sure.
value.
Yeah. So does the appraiser have any liability there?
I'm sure they do. I mean, I don't know
Yeah,
their
yeah,
back ends,
yeah,
but they do. I
yeah,
mean,
yeah,
if the
yeah,
value's
yeah.
not there, it just simply isn't there.
Sure.
They
Yeah,
answer to some type of regulatory board as well, so they
yeah.
definitely have to make sure they make that the value is accurate.
Yeah, for sure. Yeah, I don't remember a time that I've ever seen this kind of action in the market. So
Mhm.
I'm sure it's interesting for you.
It's busy.
Just on that vein too,
So
so
that's
just to follow up to what Ben said there. So are you expecting maybe because there's been such a rush to the market, maybe a correction in the near future, or do you just expect it just to stay on the rope it's been on?
Uh, it might be an unpopular opinion, but I hope not. It's tough. I mean, we do see values increasing dramatically.
yeah.
In the conversations that I've had with some of my partners, I think Ottawa's a little bit behind some of the other major cities in Canada anyway. So we're kind of playing catch up to
Mhm.
that. On top of
Yeah.
that, we get a lot of spillover from Toronto and things like that, especially now with people being able to work remotely.
Yeah.
So they're coming here, they're able to afford homes that they can't in their cities.
Hmm.
We might see a plateau a little bit, maybe.
Yeah.
In my opinion, I'm not. I don't think so too much because the
Hmm.
demand is there. Like I have people that have been looking for homes for 3 years and they can't find one, so the demand is there.
Yeah.
Yeah. Yeah, I was talking to my brother
This,
who's a real estate agent, Jordan Goodfellow Real Estate. Shameless plug, keep the change. Um, but uh, but he was saying that he thought it was a correction up, right? Like he thinks with Ottawa's been undervalued for so many years, kind of just
Mhm.
like what you said. That now it's just correcting up, and now, like you said, maybe it'll plateau. But other than that, we're kind of at where we're going to be at.
Yeah, it's good for
this,
business.
yeah, well, that's a good thing. That's a
Yeah.
good thing. So, how are first-time home buyers getting into this market? Are they? What's happening? What are you seeing there? What's the clientele like?
Some are and some aren't. If they're
Yeah,
on a
yeah,
strict budget, and I mean, 50,000, 60,000 is a fantastic annual income. But I
yeah.
mean, you can't afford a home on that anymore. Even the
Right.
condo prices, because the condo fees can be huge in the city, it puts
Yeah.
them right out of the market. I'm seeing
Hmm.
more and more where family members, particularly parents, are
Hmm.
helping with the down payment. So they're giving
Gotcha.
the down payment to be able to get in that price range that they need, and or they're co-signing. They're going on the mortgage
Wow.
because
Okay.
without it, they're not going to get in.
Yeah,
Yeah,
for sure.
Mhm.
but it's one thing
So,
too, though, getting having the down payment and being able to get into the market. But it's another thing also being able to afford those monthly payments, right? I mean,
Mhm.
if you're getting a condo for 300,000, 400,000, or a townhouse for 500,000 or 600,000 in the West End, those payments. If you're making 40 or 50 or 60,000 dollars, that'd be pretty tight squeeze, I think.
Pretty tight. Yeah.
Yeah.
Yeah, it is. I mean, the good thing, everyone's worried that we're going to overextend everybody. They're not going to be able to afford the homes and the mortgage payments that they have when rates do start going up. But, since 2016, when the stress test came into effect, we qualify everybody on 4.79%. So, if I'm giving you a mortgage today at 2,
yeah.
to see that rates are going to go up 2+% over the next 5, 6, 10 years. I mean, it's possible, obviously, but we've been qualifying people at that higher rate to try to shelter them from not being able to afford it when things change down the road.
Yeah, so that's a good point. So maybe clarify a little bit what happened with those changes. So, I think not everyone's familiar with what that means and what you're talking about.
Mhm. So in 2016, the regulators I should know the name, decided to put in some different rules for us to kind of shelter us from what happened in 2008 and what was happening in the US, where people just literally couldn't afford their homes anymore when interest rates went up from what they originally signed on their mortgage agreements. So they put in what they called the stress test. And it, at the time, I think it started at 5.25, to be honest. And they just tried to say, okay, so if we put someone in a mortgage today for 3%, and in 5 years when they're up for maturity, if it's gone up to 4% or 5%, we want to make sure that they could still afford it.
Hmm.
Um, in the industry, I mean, we all think it's a little bit of overkill for that.
Yeah.
I mean,
Yeah.
that is a big jump on qualifying rates anyway.
Hmm.
But I mean, it is to protect the clients. The difference is, as someone gets used to paying, 1,700, 2,000 a month,
Yeah.
even if rates don't go up to 4.79, if they even go from 2 to 3, 3.5, that's a big
Yeah.
jump in payment. So there are
For
people
sure.
that can get overextended.
Yeah.
But it was basically a set of regulations and rule changes back then that they put in place to try to shelter us and make sure we didn't crush the market, I guess, or crush
Yeah.
people's incomes.
Yeah, for sure.
Yeah.
So when you say afforded, I mean, I still think people don't completely know TDSR, GDSR. Like maybe you can tell me describe what that is, and maybe give us example of what that means, and so that we can maybe simplify it for people.
Yeah, sure. So
Yeah.
TDSR is total debt servicing ratio. And basically what that means is your monthly income versus your monthly liabilities that you have, including your mortgage payment. So monthly liabilities that we factor in are car payments, student loans, lines of credits, credit cards, personal loans, basically every type of credit facility that reports to your credit bureau. Um, GDSR is just the home expenses. So if there's a condo fee, property taxes, heating cost, and we have to have a certain number. So GDS is at 39%. So you can't be over 39% of your income versus your home debt. And TDS is 44% maximum. So you can't have, your total debts with your home expenses higher than 44% of your income earning.
So is that your gross income or your net income?
Gross.
Gross. Okay. Yeah.
Which is another factor too, right? Because we don't see our
Sure.
gross. So,
Yeah, nobody does.
no.
Yeah,
Yeah.
so that's a good point. So what that 2% buffer that you put on, or that 4.97 that you say, yeah, your debt scores have to be under those ratios in order to qualify, is what you're saying.
Yeah.
Yeah.
Now
And
that's
so
on
that, sorry, go ahead. Yeah.
that's on A side of lending. So big banks, A lenders. Now, if you're self-employed and you don't claim that much income because you write off as much as possible,
Hmm.
there's options where we can still get you into a mortgage, but we might have to go what we call alternative or A minus or B lending, as you would hear it. And they're lenders that will take on slightly higher risk mortgages or profiles. So
Yeah.
in turn, they will charge you a higher interest rate and charge a lender fee. So kind of a
Mm.
commitment fee for going with that lender. So it's not, you don't necessarily, everyone doesn't have to be within those ratios, but you have to
Yeah.
be if you are less than 20% down or want
Yeah.
kind of those low rates that you Google online.
So if you go with the alternative lender, we'll call them,
Mhm.
is what kind of a difference would it make? Obviously, I'm sure that's going to range a lot depending on your credit quality and things like that. But are you
Mhm.
talking like you go from a 2 to a 7, or is what's it look like typically?
You're right, it does range
Yeah.
depending on the
Yeah.
overall situation, it's case by case. But I
Sure.
mean, we have some alternative lendings right now, private B lendings, sorry, not private, but B lenders that are, I could probably do 2.99. So it's
Okay.
not a big difference where, I mean, I'm doing a
Yeah.
conventional purchase right now for 2.2-ish. So,
Okay.
but it could go up to 4. It could go
Okay.
up to 4% depending.
Yeah.
And on top of that, behind that, I guess, third option would be
Yeah.
private lenders. So
Okay.
that's when you're way outside of the conventional box and
Sure.
you still need to get a mortgage. They can range up to 7 to 10 to 11% depending on the situation.
So do you privates as well?
I do.
Yeah, I do. Okay. So would privates be corporations, individuals, or what? Like
A little
typically,
bit
would
of
you land?
both.
Okay. Okay.
Yeah, so we have
Interesting.
mixed,
Yeah.
so mortgage investment corporations. So
Okay.
we have a number of them in the city that we use. We
Yep.
have ours with Mortgage Brokers Ottawa, so Advanced MIC.
Okay.
There's Magenta, Westboro. There's a
Yep.
number in the city, so they're what we would
Yep.
call our mortgage investment companies. And then there's
Yep.
strictly privates. There's lawyers that lend out
Mm-hmm.
money. So there's
Okay.
both options that you could look at.
Interesting. And so would you do financing on more than just residential? Like, would you do cottages and commercial? Do you do those kind of properties as well?
Yep. I can do cottages, we can do land. Commercial,
Yeah.
I prefer to refer off to one of my experts in the company. So we
Okay.
can do it, and I do refer
Yeah.
to him
Yeah.
quite frequently. He's been in the business many, many years and is the commercial expert, so I leave him to it.
Yeah.
But yeah, I can pretty
Sure.
much mortgage anything.
So, we've seen the housing market take off. Have you noticed anything different in the cottage world? Because it seems like maybe that's a more mature market. Have you seen that change at all?
Yeah, people are definitely trying to run out of the city. They are trying to buy cottages or buy land to build down the road. So we are seeing more and more cottage properties, and we're
Yep.
seeing the prices in them jump like crazy too. So that's probably a tougher market than residential within the city, to be honest.
Okay, interesting. So, how do you lend against the cottage? Is it the
It'd be the
same kind of
same.
rules? Yeah, yeah,
Kind of, yep. It
yeah, yeah,
depends. So we have what we call
yeah.
like a four-season cottage or a three-season cottage. So if it's
Yeah.
four-season cottage with year-round access, it would be the same type of lending as your residential home here in the city.
Okay.
If there is a three season, so maybe it's lake water intake. So,
Yeah.
in the winter, there's not going to be any water intake. If it's not insulated or heated, it'd be considered a three season. Then we use one of our default insurer programs for that. So you pay a little
Okay.
bit of a premium with the
Mm,
lender, whether you're putting 20% down or less, you pay the premium either way.
okay.
But interest rates are standard rates, so it's pretty much the same.
Okay. What about for land? How do you lend on land?
Little harder.
Yeah, I
Most of my
guess.
lenders, yeah, I probably have two or three lenders that I know of. I'm sure if anyone sees this, they'll reach out to me afterwards going, I lend on land. Um, and usually they're looking for a 50% down payment on the land because,
Okay.
it's harder to resell. They don't have,
Sure.
the house to actually have as a lia or
Yeah.
an, collateral on it. So it's a little bit
Sure.
harder for land, but we could do it.
Yeah. 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 So, are you still seeing people use their first-time home buyers plan when they're buying houses? Do you see that kind of activity still? And maybe you could, I mean, I could certainly describe that, but maybe you could describe what a first-time home buyer is because I still got clients and kids. They ask about putting money into their RSP versus putting money into TFSA. And maybe you could tell me a little bit about how that works.
Yeah, so absolutely. I mean, we're still using the first time home buyers incentive, or sorry, first time home buyers plan. So what that would
Mm,
be is if you have RSP savings, you're allowed to withdraw them. Uh,
mhm.
oh, you're stumping me right now. 35,000 per individual.
Yes.
Or
Yeah.
yeah,
Yeah.
35
Yeah.
per individual buying the home
Yeah.
um, for the purchase of a new qualifying home, and you have 15 years to pay it back. I used to rhyme
Yeah.
that off super quick in the
Yeah.
bank, but
Yeah. Yeah.
15 years
Yeah.
to pay it back. So you're kind of
Yeah.
borrowing from yourself tax free.
Yeah.
So
Yeah.
we are seeing it, but honestly, if it's a first time home buyer and they're trying to get in the market a little bit younger, they don't
Yeah.
have a huge amount. So those are probably the clients I'm
Sure.
seeing the parents gifted, but
Yeah.
it's
Yeah.
still being used. It's still a great
Yeah.
program.
Yeah.
And tax free is just, tax free savings you can pull out for any purpose whatsoever. So.
Sure. Yeah, exactly. Yeah, I think people still forget about the home buyers. I guess if you're a high income earner when you're young, which there's some in the city, obviously some of the tech
Yeah,
people have
absolutely. Yeah.
have hit it off pretty quickly. So it'd be in their cases it'd make sense to be maxing their RSPs and then pulling them back out tax
Mhm.
free. So
Yeah, I mean,
yeah,
there's been
so
a
it
few clients where, they've had the savings sitting maybe outside of an RSP, a savings account, a tax-free account, and we
mm,
knew that they weren't buying a home for the next 3 to 4 months. And,
yeah,
income there, it's very particular person, client that we would advise this to, but, I would
sure.
advise make the contribution, put your 20, 30,
Yeah.
40,000 in your RSP. As
Yeah.
long as you're contributed to the RSP and it can stay in there for 90 days, we're
Yeah.
allowed to pull it for the home buyers. So, you're putting it in, you're getting your tax break, and you're taking it out and using it what you were for anyway. So it does,
Yeah.
if I see that with my clients, I do advise them to do it that way. But usually by the time they come to me, they're making an offer and buying next month, so it's a little too late.
Yeah, I mean, I think that's market driven, isn't it? Yeah,
Mhm.
people are excited about what's happening. It's really hard to believe. I mean, you're right in the midst of it right now, and we see it in the papers, and we see Ottawa going vertical.
Mhm.
I guess it's got to be hard to keep up.
It is. Things change every
Yeah,
day.
yeah, yeah,
But yeah, I mean, when it's, and the big thing too with being a mortgage agent versus working in the bank, and there are some bank mortgage specialists that only do mortgages, but for the most part, if you walk into a branch, you're getting someone that has to do everything. They have to know how to
yeah.
do bank accounts and credit cards and savings and investments and mortgages. So they're not going to be able to keep up with the numerous changes and the rate options and, the out of the box deals. So when this
Sure.
is all you do, live, breathe, eat,
Yeah,
sleep,
yeah,
it's
yeah.
easier to stay on top of it. So,
Yeah, for sure. I mean, I've seen that with your work firsthand. So, what obviously there's been quite a few different kinds of mortgages these days, and I know Scotia has a step plan, and all these different companies have their different kind of mortgages. Maybe you can tell me a little bit about the different kinds and the different features, maybe, and just some kind of understanding for people.
yeah, sure. So there's your standard mortgage where you just have your 25-year amortized mortgage and you make your monthly payments on it. Any type of mortgage lender that I would work with usually allows a annual prepayment of a lump sum prepayment of either anywhere from 10 to 20%. They all kind of vary depending on the lender and the whether it's fixed or variable. They also allow increase for payments. So if your monthly payments, $1,000, you can increase that by 20% every year as well. So that's two benefits to help you pay more principal off on your mortgage and bring down your amortization over time.
Hmm.
Then there's the mortgages like the Scotia Step, like you mentioned. And we have a few lenders that offer that. MCAP is one of them, where they have a mortgage and a line of credit component. So it's one charge against the property for X amount. And then we can say, the mortgage is for 500,000, the line of credit is for 200,000, and you don't have to be using line of credit. It can just sit there for future emergencies, redo your roof in 5 years, whatever the case is. It is secured against the home, so it's usually a much lower interest rate than an unsecured line of credit that you'd get at your bank. And
Hmm.
as you pay your mortgage balance down every month, the available credit limit on the line of credit increases. So by the time your
Oh,
mortgage is fully paid off, you might have, an $800,000 line of credit at your disposal to use as you see fit. More
wow.
and more, we're seeing people get these lines of credits and use them to buy rental properties.
Sure. Yeah, that makes sense. That makes sense. Interesting.
Mhm.
Yeah, I think that, having done this and obviously owned a number of homes too, I still think people don't understand the nuances of mortgages. So maybe talk a little bit about how if you're breaking your mortgage or you're buying you're shifting, your refinance, you're breaking a mortgage, typically how's that calculated and what kind of charges that look like?
Yeah, that's one of the favorite questions, I think. And it's really hard to give a straight answer on it because it's
Yeah.
really, the calculation behind the scenes is a little complex. But I mentioned earlier that my monoline lenders have usually more favorable calculations for their prepayment. They're breaking their mortgage and getting rid of it, penalty
Okay.
calculations than the big banks do. Reason being is because they calculate your penalty based on
Yeah.
the interest rate that you're actually paying.
Okay.
Whereas the big banks will calculate the penalty based on what they call their contract rate, their poster rate. So if you go on a big bank's website right now, you're going to see a poster rate of five and change. And then
Sure.
when you go into the branch, they say, well, your rate's actually going to be two. We're going to
Yeah.
take, 3% off of that for relationship pricing. But when you go and break your mortgage, they're going to
Yeah.
charge you a pre-penalty, what's called IRD, so interest rate differential. And it's a number of factors, but it's based on what your current interest rate is,
Yeah.
what your interest rate is, sorry, versus current interest rates. And they
Yeah.
don't use your interest rate. They use this 5%. So it can make the differential much larger
Big,
than it needs to
big.
be.
You're right.
And it depends on how far into your term you are, what your balance is. So there's a number of different factors there. It's a reinvestment rate, which you could probably
Yeah,
speak more to
sure.
than I
Yeah,
could.
yeah.
And then, so that's your standard. If you were in a 5-year fixed or a 3-year fixed or any type of fixed product,
Okay,
your penalty would be based off that IRD. If you're in a
okay.
variable rate product, your
Mm-hmm.
penalty is based off of 3 months worth of interest. So it
Okay,
can be a lot less.
sure.
It's a lot easier to calculate. You take your balance and your interest rate and figure it out. But yeah, I mean, or third option, and cut me off if I ramble too much.
That's okay.
We can avoid penalties altogether. If you're just simply buying this house to move to this house, we can port your mortgage, is what we would call it. So as long as the mortgage amount stays the same or is
Mm-hmm.
increased, and depending on the lender, you have a certain amount of days to do the buy and the sale, we can
Yeah.
simply just move your mortgage over to the new address and avoid any penalties for you. So there are
Okay.
options to try to avoid a penalty if you're moving to a new home.
Yeah. Okay. That's great. And so, how have you seen rates change? I guess we came down pretty hard. Are we starting to see them creep back up again, or is it?
Yeah,
Yeah.
yeah, absolutely.
Okay.
I would say a little bit over 0.5%, probably in the past 2 to 3 weeks, and it happened
Wow.
pretty quickly. Yeah, it happened
Uh,
really quick,
yeah.
and it kept just happening. So we were getting notices from our lenders.
Yep.
Rates are going up. If you have any pre-approvals, call out to your
Yep.
clients, get your deals in now.
Yep.
So it's great because our lenders do give us that notice, which is fantastic. So
Yeah.
if we do have anything that was kind of on the fence, we can jump on it. But yeah, we've seen at least a 0.5% increase in some cases over the last 2 to 3 weeks.
Okay. That's huge. That's a big move.
And I think it's, based on the bond market, which again is your area of expertise there, but that goes up and mortgage rates go up. So,
Yeah.
and this is
Exactly.
usually the time of year where we see them going down because it's a
Right.
spring market. Other lenders are trying
Yep.
to compete with each other to win the business, and we're seeing
Yep.
the exact opposite. So it's throwing
Yeah.
people for a little bit of a loop.
I guess. Well, I think rates are coming down in the back half, if that means anything.
Yeah.
But so that's a positive for sure.
Yeah.
So what's the typical mix have you been seeing people coming in? Do they typically do variable still or fixed or what are people been doing? Because I mean, statistics looks like they've been primarily doing variable, but what are you seeing?
Past year, I'd say I'm probably doing more fix than anything, just because they were
Okay.
so low.
Yeah, for
It
sure.
was extremely low. The past
Yeah.
month, I've been recommending variable because they're still so
Yeah.
low. Like we're still 1% below prime, prime being
Wow.
2.45. In certain
Yeah.
cases, every mortgage is a little bit different.
Yeah.
So we can do 1.45 on a 5-year variable.
Wow.
We don't have a crystal ball, but I believe that it's going to be some time before the Bank of Canada starts raising their rates again.
Yep.
So why not ride it out? I mean, historically, variable has always come ahead over fixed. So if you can stomach the maybe a little bit of fluctuations here and there, it's the way to go.
So tell me how that works, like a variable, like a five year variable. You're saying 145. So what does your mortgage payment the same, but your principal and interest changes, or your payment changes? Maybe describe that a little bit.
The lenders that I use, the payment changes. So that's
Okay.
another big conversation I have with my clients. If they're first time home buyers and they're on their budget, or even if they're not, and they just like knowing their payments fixed and they don't have to worry about it, it's not going to be the product for them because it does fluctuate. There are certain lenders out there, I'm not sure if they still do it,
Yeah.
that it would stay the same. What they would
Okay.
change is the ratio of principal versus interest. And then at the end of the 5 years, if not enough interest got paid off, they would say, "Oh, you owe us a big payment." So it's called a balloon
Wow.
payment. So you owe us
Wow.
$10,000 because you didn't pay off enough principal, and we can't
Okay.
extend your amortization. So not sure if they still do it that way.
Okay.
But now the lenders that I use, the payment fluctuates with the interest rate.
Got
So
it.
what's the
Got it.
appetite for that?
Got it.
So with people that get mortgages, or do they like the consistent payments every month, or do you convince them more of the not convince them, but are they okay with the variable? Like what is it, like 50-50, or what do you find?
Probably more fixed, to be honest.
More fixed, yeah.
Probably more people go
I can see
fixed.
that.
I have a very detailed conversation with them. I make sure that they're going to be comfortable. They're not going to lose sleep at night.
Sure.
A good thing about the variable is any of the lenders I would recommend, they do allow you to convert it to a fixed. So if interest rates do start creeping up a little bit above their comfort level, we can contact the lender and convert it to a fixed rate at that time.
So
Wow.
what's that process like? Is it a phone call and then you convert it, or is it
Pretty
like,
much.
yeah, pretty much?
Yeah,
Yeah.
it's not
Okay.
a full application. It's just a phone call, a sign
Yeah.
here, and you're done.
Okay.
Yeah.
Okay. That's good. That's good.
I'm learning so much about mortgages. I had no idea. I had no idea. It's great.
Hey, we're going to dive into the mortgage insurance. So we're going to have that conversation. Maybe you can tell me a little bit about mortgage insurance and how that works in those conversations.
Okay. Like default insurance, you're referring to?
Yep. Yep.
So I mentioned a little bit earlier. So default insurers, we have three of them that we use in Canada. CMHC is
Mhm.
the big one most people
Yep.
have heard of.
Yeah.
The Genworth, previously Genworth, now Seguin, and
Yeah.
then Canada Guarantee. So these default insurers come into play when you're purchasing a home, only
Yep.
purchasing, and you are
Okay.
using less than a 20% down payment. So you're
Hmm.
considered a high ratio purchase.
Yep.
And basically, you pay this default insurance to, for lack of a better way to put it, cover the bank's butt. If you don't make your mortgage payment, they're insured on it. So the premiums are tiered based on the amount of down payment. So if you put minimum 5% down payment, the
Hmm.
default insurance premiums are going to be 4%. And that
Okay.
4% of your mortgage is added
Yep.
to the mortgage. So it's not out of pocket at time of closing. We just roll it into your mortgage. It's spread out through the lifetime and it's a one-shot deal. If
Right.
you put 10% down, the premium goes from 4 to 3.1. And
Okay.
if you put 15% down, you go to 2.8.
Okay.
Anywhere in between those tiers
Yeah.
are the rates are still the same. So it doesn't
Sure.
really matter. But once you hit that 20 mark, you don't have to pay it.
Yep. So, and the three different insurers that you say, is it static? Why do you choose a different one? Like, how do you do that? What's the rationale?
Some lenders we don't have a choice. The lender gets to pick.
Okay, I got
So
it.
some of our like monoline lenders, they only use two of them, say. So we know if we want to go to one particular one and they don't use it, we don't go to that lender.
Yeah.
Um, there's been a lot in the media over the past year and stuff about certain default insurer companies. So they've one particular made some pretty drastic changes to some rules, I guess about a
Sure.
year ago now,
Hmm.
that put some people out of the ranking with that insurer. So we have to request a particular insurer going into a lender.
Okay.
Yeah. So they
Interesting.
changed the minimum credit score.
Yeah.
So normally minimum credit score is usually based up to the lender. So they look at the risk
Yeah.
and if there's a
Yeah.
good reason for a low credit score, they can go to the default insurance, say, we like this file, this is what
Yeah.
happened,
Yeah.
we believe this client's gonna be good.
Yeah.
This particular insurer decided that they're gonna do a minimum of 680, which
Yeah.
puts quite a few people out of the rankings. So
Yeah, for sure. Yeah, so you make a great point. I mean, the benefit that you have is, if you get a client with a credit score that isn't great, you can choose different places. But with the bank, like it's rigid, right? Like if you're in this box, you're gone. You
that's
don't
it.
fit in. Yeah, okay.
Exactly.
Maybe you can talk a little bit about what goes into the credit score, because I still think people aren't familiar with that, and so maybe talk a little bit about that, and maybe talk a little bit about the different levels too of yeah, please.
So it's kind of still a little bit of a mystery to me, even,
Yeah, yeah, yeah,
because you see someone that has, a few credit facilities, they've always paid on time, and for some reason their score comes in at 650. And then
right,
you see someone else that had a late payment or whatever, and their score comes in at 725.
right.
But I mean, really, it's based on the number of credit facilities that you have.
Okay.
They like two to three different types of facilities, like a credit card, so that's a revolving type of credit, an
Hmm.
installment, so like a car loan or a student loan repayment or something, or mortgage. It's an installment loan that you make. So they like two to three different types of facilities on your credit. Usually, you'd like to see about a balance of 2,000 or more if you hold a credit card, because you don't ever want to go over. I think it's even dropped a little bit more, like 50%. But I always used to tell clients, don't go over 70% of your limit. So if your limit's $1,000, don't ever spend more than $700 on your credit card. Keep it far away from that max limit as possible, because as soon as you start getting to that max credit limit, it's going to
Yeah.
start affecting your score. And then
Interesting.
if the
Okay.
interest charges come in at the end of the month and you're right at the max and then they charge you interest, you're going over the credit limit, that really hurts your score. So it's
Okay.
always good to keep it as low as possible. Keep credit facilities for a good amount of time. Like if you've had a bank card for 10 years and then you change banks for whatever reason, I recommend keeping that credit card because it shows history. So you've built a history
Okay.
of that credit card, you've had good payments, whatever the case may be. But as soon as you shut that down, that's gone.
Yeah.
And then you're starting over from scratch with your new bank. So having
Interesting.
long tenure with credit facilities is good as well. Um, credit scores can range from 0 to super poor as low 500s.
Okay.
The best in Canada is 900. We call
Okay.
that the unicorn. Um, Probably seen 4 in 15
Okay.
years. Um,
Nice.
yeah, so it's
Yeah.
funny when you get there, you're like, "Oh my God, I have to call somebody and tell somebody that this
Yeah.
is
Yeah.
happening."
Exactly.
But yeah, I mean, it's good to have a number of different facilities, and please make your payments on time. It's the
Yes.
biggest thing.
Yes.
Don't be a day late.
Yeah. Yeah. Exactly. Exactly. Those 900 scores would probably be good clients for us, I think.
Yeah, probably.
Good thinking, Ben.
I'll
Good
keep an
thinking.
eye
Scott,
out
any
for you.
Scott, any questions popping in as we go through here?
Oh, I got lots of questions here. You're really just trying to get in the weeds of the mortgage broker industry here. Hey, you just keep asking those questions, digging a little deeper. Ben likes to
Well,
go extremely.
these.
What's that?
I'm just trying to help people understand. There's lots of
Ben,
nuances within it.
Ben.
Yeah.
That's why you're
Yeah.
great. You just go deeper than anybody else does. It's great. One thing
Yeah.
that Renee mentioned, and Ben, maybe this question might be more for you, but maybe for both of you, is that Renee mentioned that there's times where you can pay 20% down on the principal of your home. But would we recommend the Hard Investment Group? Would you recommend doing that, or is there a better place to put your money?
This is a great question.
Why
I
don't
think
you
it's going
start
to
with
be a
that one,
personal
Ben?
answer. Yeah, I mean, look, I'd say, there's an easy argument to be made that if I can't do 1.45%, then I'm not doing a good job.
Mm-hmm.
So I would say in most cases, the answer is probably no, I wouldn't recommend it. But each individual client has their own goals and objectives. But, if it's a simple comparison for me, and if they got a 4% mortgage, they're paying 4% on it, then maybe I'd consider it. But in today's market with rates where they are, typically wouldn't be a recommendation.
What
Renee,
do you
any
think?
comments?
Yeah.
Same. I mean, I tell clients all the time, I've had for years, and it's the same thing.
Yeah,
Like you said, everyone's a little different. Some clients, it's just they want that mortgage gone and they don't care about
yeah,
anything else.
Yeah.
yeah,
But, if you can sit back and look at it, a lot of my income property investors, they do the same. Like they want to buy the rental properties, put minimum down. They don't care that the amortization is stretched out to 30 years because it's just a part of their portfolio. They would rather take that money and invest it than pay down their mortgages. So I agree.
yeah,
Yeah.
yeah.
And I
So,
do agree it's a personal preference. My ex neighbor always said that if as long as I have a mortgage, I have a problem, right? So like, he didn't feel like he was free until he was really debt free, right? And I think that's just a mindset
yeah,
that people have, right? And if they can't,
sure.
as long as they have that hanging over their head, they don't feel like they they can be successful. So yeah, for sure. So on that same
Yeah,
vein, why don't we continue? Oh, sorry, go ahead, Ben.
Yeah, for sure. I mean, I think that a lot has to do with how you're brought up and how you think about money, and I think age group makes a big difference too. Older people definitely don't like that mortgage. It feels like, they have those flashbacks of paying 20% interest on their mortgages, and they
Yeah.
don't want to ever feel at risk of that. But I don't think there's any risk of rates going anywhere. I mean, I think rates are pinned near zero for the foreseeable future.
Yeah, exactly.
I like that.
Yeah.
Well, so let's take let's have a group discussion here. Let's take the actual somebody's home, right? Their familial home that they own out of the equation, and let's just talk investment property versus the market. What are some of the pros and cons? I guess we could see on that, and maybe have a bit of a debate here about what may be a better investment vehicle.
Yeah.
Go.
Yeah.
Why don't you
So
start
you
there,
want
Ben?
me to go?
Yeah, you start.
Yeah, sure. Okay. Yeah, so look, I mean, I think that we can go at this from many different angles. I can talk from firsthand experience about owning a rental property previously, being a landlord, owning a triplex, and I can talk about a personal feelings around how that worked. I think some of it has to do with I mean, I guess the question is, what's a better investment? The one thing that real estate always has versus investing is real estate as leverage. So to Renee's point, if you put down 5% into a house, you're only putting down 5% of the principal. And so the one thing I think that often doesn't get calculated if you put $1 million into a house and you put down 50 grand, you got $1 million asset. So if you went into an investment portfolio and you're able to put down 50 grand into $1 million investment portfolio, history shows that the markets outperform real estate, but in the markets, you don't get leverage. You can't put $50,000 into $1 million investment portfolio and get exposure to it. So, I think that sometimes there's a misunderstanding around the two of them.
Ben, you're arguing for the wrong side here.
No, I'm not. I mean, I think if you do that comparison, if you think
I'm
about it,
fine with it.
yeah,
I'm fine with
yeah,
it. It's great.
yeah. No, but it's true. And you think about it, if you could take 50 grand and get $1 million investment portfolio, wouldn't lots of people do that?
Yeah, great deal. Yeah. No,
What? It's a great
yeah,
deal. Well,
I,
I mean, they're going to make more money too.
yeah,
But
yeah, for sure.
real estate grows because they get the leverage, and
Yeah.
people I think misunderstand the fact that if you're investing in equity markets, you don't have the ability to get the same kind of leverage that real estate gives you. So we need
Thoughts
to
on that,
find
Renee?
create a product that can do that.
Yeah, sure. Let's do it.
There's always the mix, right?
Yeah,
Yeah,
yeah.
for sure.
Yeah.
Any
Yeah, so
thoughts
I
on that?
think I
No?
mean,
Yeah.
Renee, go ahead if you want to add some comments.
Yeah, I mean, I'm on the same page with you, obviously, a little bias on my side, but it's having a tad bit, like a little sprinkle of, the financial advice background. It's a mixed portfolio for people. I mean, like you said, real estate's great to invest in. Who saw uh, a stable, very low risk 13, 18% return last year? If you owned a home in Ottawa, you did.
Hmm.
So it's a little bit crazy, but I mean, you can't obviously have all of your eggs in one basket. So that's where you come in. But it gets tricky. I
Hmm.
don't know if you want to go down that rabbit hole at income properties, but
Yeah.
it gets a little bit trickier as you try to dig into those, and they are a little bit different than buying your primary home.
Yeah.
Yeah, you
Yeah,
saw
and I
those kinds
think
of
that I mean
returns in real estate and in Bitcoin, right, Ben?
you saw Bitcoin 400% return, but I digress. So there's money to be made. I mean, definitely. I mean, real estate versus asymmetric returns aren't even in the same category. I mean, real estate has been a stable cash flow tool. It's different too from you're not comparing apples to apples. But the market definitely has those kinds of, I mean, Bitcoin, like you have those kinds of things that can return a multiple. You're not going to get that in real estate ever, unless you hold it for 25 years. So yeah, I mean, I'd think that it works from a rental perspective. It works for some people, but that. As I said, we owned a property, and I'd never do it again. It just wasn't our thing.
Yeah.
Wasn't our thing. It's a lot of work, and you have to think about what you're doing, and also you need to be able to make the cash flow. Like if you're not handy, you got to be able to make the cash flow in order to pay for someone taking care of your property, and oftentimes that doesn't get factored in. I mean, I know there's a book out there written by a guy that used to work in real estate at CIBC World Markets, and he wrote a book about renting versus buying. I can't think of the name off the top of my head, but maybe maybe we'll put it in the notes. And it's an interesting read, and he does compare the different cities across Canada and say, well, in this city it's more effective if you rent, or in this city it'd be better if you buy, just from the perspective of where the real estate market's at, and some of the inputs that go into owning a home that people don't typically think about. So I think that's a decent frame of reference too to look at if you're considering it.
What about from a mortgage standpoint, as far as investment properties are concerned? I know, like, what are some of the requirements as far as down payments, as far as what you look at as, I know there's cash flow plays into a factor there as well if they have multiple properties. What do you typically look at for investment properties?
So right off the bat, the first thing I tell my clients is minimum 20% down. So if
Mm-hmm.
it's a rental property, it's a minimum 20% down. Then half the time the conversation stops right there because
Yeah.
they don't have it. So
Gotcha.
20% down payment. The lenders are going to put a little bit of a premium on the interest rate. As a rental property, it's deemed a little bit riskier, to have vacancies. The person living in the rental property might not take care of it as much as you would if it was your home. So there's a little
Hmm.
bit added risk there. So the lenders usually add anywhere from 0.15 to 1/4%, or maybe a bit more sometimes, to the standard rates for rentals. And then we have what's DCR. It's a debt calculator ratio. And basically every lender has their own. So every lender is a little bit different. So they take the mortgage amount, the mortgage payment, property tax, condo fees as applicable, home insurance. They have a percentage for vacancy. If there's maintenance fees, things like that. So basically, if you're have a $2,000 rental income and your mortgage is 1,500, in your mind you're going, I'm making $500. Not really, right? You have like the property
Yeah,
tax and the maintenance fee. If the furnace blows, it's your
yeah,
job.
yeah,
So it is harder to qualify. And the big kicker is for the people that want to build the income property empires. Most of my lenders top off at five. So
yeah.
maximum five rentals. So it gets tough. And then you're looking at going into the B world for the most part for lending. So then those rates jump up again.
So do
Maximum
they get to
five
use the
maximum five rental
properties?
properties
Yeah.
per person or per,
Per
I guess,
person.
owner. Yeah, per
Mhm.
person. Why would they do that?
Like some lenders allow
Just
it. Like
risk.
Desjardins is a
Yeah.
lender; they have unlimited.
Yeah.
But it really depends. A lot of people want to put their income properties in a holdco, like a
Yeah.
corporation name, for tax
Yeah.
purposes. Out of my 60 plus lenders, I have one that I'm allowed to do that with. So
Yeah.
it really narrows the options. It's tough. It's a tough market to get in for sure.
Yeah, so I know, like, I helped a guy who was buying an 8 unit, and we had to do four at CIBC, and then we did four at Scotia because they wouldn't do them both at the same place. I mean, it's
Yeah.
ridiculous. It's the same thing, but they didn't want to take the risk, so
That seems odd
Did
we
they
too.
we
Like
make
did
them
it
go
that way.
commercial at all, or?
No, they let him get away with that. Yeah,
Okay.
yeah,
yeah, it
yeah.
seems odd
Interesting.
that when you get to those numbers that you seem like you're actually being successful with it. So why would they stop you there? I wonder. But I guess it's risk, right? It all comes down to risk.
Risk. Yeah,
Yeah.
yeah.
No
So do they
appetite.
get to use the cash flow from the property as part of their income? Does that go into? Yeah,
Yeah,
yeah.
if there is some.
100% of the cash?
Yeah, after all the calculations, like it'll pop in a number. One
Yeah,
of our simplest lenders, basically they take the mortgage payment and they take
mhm,
50% of the rental income, and
got it.
that's what you use. So if you have a surplus, great, you add it as income in the
Yeah,
income section of the application. If you
yeah,
have a deficit, then you have to add it as a liability on the application. There's some lenders that are a little bit different. Like there's a
yeah,
million different scenarios, but
sure.
it's very rarely do we see a surplus on paper.
Got it.
Hmm.
Got
Yeah.
it.
And just the last question on that. So do you see a lot of people trying to get in the real estate investment world? Like, do you have a lot of clients that have real estate investments? Something people want to
Yeah,
get in. I
I have
think I
quite a
think it's
bit.
one of those things that's attractive, but when you get into it, like Ben knows, right? They don't realize how much work it can be, right?
Yeah. It's actually a lot of young people I'm seeing
I believe
trying
it.
to get
Yeah,
in. I don't know if mom and dad told them they wish they'd done it 20 years ago and they're wanting to do
Yeah.
it, but it's
helping.
young
Yeah,
people that are buying rental properties and still living at home with mom and dad.
yeah,
So maybe it's a good strategy for them, but I know when I was that
yeah.
age, I wanted out. I just so, but yeah, it's pretty amazing still the amount of people that I see trying to do it.
Yeah.
Interesting.
Yeah, I think it's exciting. I mean, I got my wife and I bought a triplex when we were still in our 20s, I think, probably late 20s. It was the only way we'd get in the market. We wanted to be downtown. And I was telling Scott earlier, some of the handyman work I had to do around the place wasn't up my alley. But if you can do your own work and do all those things, it's something I think that's exciting and attractive for people to get involved in. But it ends up being a pile of work for sure.
Yeah,
Yeah.
I wouldn't do it.
Yeah, for sure, for sure.
All right. Well, we're at.
I
It's been
yeah,
like an hour, just flying by. Eh? We
I
get
know.
it's like going back down memory lane for me. Circling back to the X analogy. Just having coffee with the X, being the industry real estate, of course. That's my disclaimer in case my wife watches this. Um, we'll cut that part out.
Yeah,
Okay. Do you
yeah,
have anything? Do you want to
exactly,
wrap? Do you want to
exactly.
wrap it up there, Ben, or do you have anything else?
Yeah, I
Or
think so. I think so. I mean, I think this has been great. I was just looking over to see if there's anything I missed I wanted to cover with you. Was there anything else that you thought that people should know? Anything else that you'd recommend before we go? I think you've covered a lot of things and gone into great detail. I really appreciate your time. Is there anything else you want to add?
Not really. I mean, just if get a pre-approval, talk to somebody. If it's not a mortgage agent, selfish plug, I'd be your best bet to go to. But talk to someone before you jump in and start looking at homes. Make sure you have your ducks in a row, and don't be afraid of the rates. People are panicking right now because we're seeing
Yeah.
2.25. When
Okay.
I started doing mortgages 12 years ago or so, they were 6%.
Yeah.
Maybe more like 14 years ago. So
Yeah.
it's not a scary time. But yeah, talk to a professional before you start jumping into looking at homes and make sure you got your ducks lined up.
So just before we leave that, how long can you lock in that pre-approval? Like how far out can you go, like if somebody does that?
120 days.
Okay, awesome,
Mhm.
awesome. That's good advice. Scott, I think we're ready to wind it up.
all right. How do we normally wind this up? I don't even remember. We just click the button. Is that what you're just waiting for me to click the button and just hang up?
No, I think
All,
no, I think that's
all
good.
right. All right. Well, thanks a lot, Renee, for coming on. We really appreciate it, and we'll definitely have you on again. I wasn't sure, you're like, how was this gonna, fit in the investment world, but we definitely kind of linked it all together. So we appreciate you coming on. And again, if anybody's looking for you, it's Reni McNeil. What's your email address? It's what is it?
At mortgagebrokersottawa.com. Longest email in the world.
It really is. I know. I remember that. That's
Type in
why I
Renee
forgot it.
McNeil in Google with Renee with an I, and I'm the only one.
Yeah, yeah, that's the best bet. Okay, well, that does it for episode number 12.
Perfect.
Thanks for watching and listening, and we'll see
Awesome.
you next week.